This is Boomer Life on CL 650.
You got to know when to hold up, know when to fold up.
Welcome back to Boomer Life on CL 650. I'm Joanne Sutton. Today we're speaking with JimDoyle, Senior Financial Consultant with Investors Group Financial Services. And the last two segments of the show, the very first two, were a complete eye-opener for myself. And they highlighted the value of working with an experienced financial planner. Jim, I really like how you mentioned earlier the concept of a benefits treasury when working with a financial planner. Financial and a quality of life benefits like comfort, peace of mind, confidence, excitement, and fulfillment. Yet for a number of Canadians that are close to retirement, they're just not that confident about being able to sustain their current lifestyle as they age and move into retirement.
A new survey from Mackenzie Financial highlighted how 4 in 10 Canadians believe they're in a better financial position compared with a decade ago, but only 25% of those closest to retirement echoed this sentiment. Now, I normally shy away from a lot of facts and figures, but I hope you won't mind if we share a few of them today in support of this conversation.
Absolutely. Now, isn't Mackenzie Financial one of your sister companies?
Yes, it is. This study shared some concerning insights. Specifically, of Canadians aged 65 or older, 42% stated that their financial position has not changed dramatically in the previous decade, while approximately the same portion stated their lifestyle has changed negatively over the past 10 years.
It seems to suggest for a substantial percentage of those over 65 that they might be seeing their financial situation actually deteriorating.
One of the most troubling findings was less than 35% of Canadians in the plus 55 to 64 age group believe they are definitely on track to meet their retirement goals.
Less than 35%, that's a bit of pessimistic news, perhaps suggesting a lack of confidence in retirement planning and being able to sustain their lifestyle. It just doesn't sound very good.
The survey finds, for example, 37% of Canadians who are typically preparing for retirement, those aged 55 to 64, don't contribute to an RSP.
Is that number a little higher or lower than the average for all age groups?
I think it's a little higher. I think the study's authors suggest 35% of Canadians don't contribute to RSPs. But it also highlighted a couple of noteworthy figures. Only 18% of Canadians overall feel confident in their contributions to an RSP, and an overwhelming majority of Canadians, 72%, do not have a written financial plan in place.
This may seem like an obvious question, but Jim, what is the significance of not having a written financial plan?
We spoke earlier about seeking the benefits of financial and emotional security, but I think Carol Bizaire, Vice President of Tax and Estate Planning with Mackenzie, said it best in a statement about the study. People who worry about their financial future but don't have a financial plan are like people who worry about getting lost but don't use a map. Both a map and a plan are easily available. Both reduce a lot of stress, and both typically help you reach your destination.
Well, here's another redundant one. Should more Canadians be seeking financial advice?
Well, currently, 58% of Canadians don't use the services of a financial advisor.
Well, that number seems high, especially, as we spoke of earlier, those who work with an advisor over 15 years on average, they have added 290% more to their portfolios than those who never use the services of an advisor.
One positive from the study, those who do use a financial advisor tend to be more knowledgeable about financial products and confident about their financial situation. Now, there are some headwinds to overcome. The study mentioned how saving for retirement may be confusing to many Canadians, with 29% feeling indifferent. 23% feel overwhelmed, and 20% are confused when it comes to their investment options for retirement savings.
I still can't get over the difference in assets by someone who actually works with an advisor. It's crazy.
Well, according to the 2016 Serrano study, there are two significant factors which account for this difference in assets between those with advisors and those without. One factor is a higher rate of savings for those with an advisor. If you have a financial advisor, you increase your savings rate. And if you increase your savings rate,
well, then you increase your wealth. Did that study offer any statistics on the impact of savings rates when working with an advisor?
Yes, it did. It said Canadians with an advisor had an annual savings rate of 10.75% compared to non-advised Canadians whose annual savings rate was 6.7%. If you can imagine doing this regularly over a long period of time, saving more for a third more, okay, that's got to improve your bottom line.
Absolutely. So what was the second major factor?
The second major factor that plays a role in the ability to increase assets is financial discipline and better disciplined behavior. The discipline to look at and monitor your plan regularly. The discipline to stay in the markets through both positive and negative cycles, as well as the value of balanced market portfolio advice and the benefits of diversification.
I actually hear this one a lot, diversification, but I'm not sure exactly what it means.
It's a great thing to understand because it's one of the most important tools available to investors. Diversification allows an investor to reduce investment risks while potentially improving investment returns. The fabled, you don't put all your eggs in one basket. But here's the problem. On some level, it might be a bit counterintuitive.
Okay, I have to ask, why is that?
I've had this question asked a few times. Why in the world would we want to invest in a mix of investments where some do well and others perform poorly? Why not only invest in the good investments?
It's an excellent question. Do you happen to have a simple answer?
I do. The reason why investing only in the good investments won't work comes down to one simple fact. We don't know the future. Future performance of stocks and other investments rely heavily on future events that no one has any reliable way of predicting. And that's why we must diversify. But this can be tricky for many investors who believe that they are well diversified, but on closer inspection, they're often concentrated in a single asset class.
So what does real diversification look like? What does it entail?
It should start with ensuring that you have more than just many holdings. It means owning multiple asset classes that behave differently in various market conditions and respond differently to various economic events.
So if I had a portfolio of just, say, tech stocks or one of only dividend-paying stocks or maybe high-yielding corporate bonds, I really might not have good diversification.
You're right. Even some portfolios that include both stocks and bonds may not be sufficiently diversified. Take, for example, a portfolio of U.S. stocks and high-yield corporate bonds that are both dependent on the fortunes of U.S. companies. If they're highly correlated at the wrong time, it could see them going down when markets fall.
Isn't this what I want my investment advisor to be looking out for?
I want to burst a major investment bubble. Advice that seeks to consistently outperform the market is realized by few financial advisors. Yet it seems many are hardwired to seek this out. So it's not surprising that while some will benefit from professional guidance, 28% are unsure of where to turn to get professional advice.
We hear it all the time, Jim. A significant number of Canadians are simply not saving enough money and constantly worrying about their finances.
Canadians are not oblivious to their economic woes. FPSC, which is the Financial Planning Standards Council, says that 2 out of every 5 survey participants said they worry about money at least once a day, and about 1 in 4 stated they worry about the money issues almost constantly.
What you need to know as a listener, as Jim has been doing this for almost 27 years, and he's definitely the guy to ask the questions to. He is the guy that has the answers. So, Jim, what are some of the biggest reasons that you might want to monitor or reassess your financial plan on a regular basis?
Maybe I can use this analogy. If I don't watch my weight, it's easy to add on a few pounds, and then a few more, and so on. Over time, there may come a point where I have to do some things to take the excess weight off, and that's not always fun. By watching what I consume, have a little regular exercise, and visiting my doctor regularly, there are steps that I can take to monitor my health. My financial health really isn't that much different. The difference here is that I can easily see my belly. However, money's ability to serve me well over time, that's not so self-evident.
That's the $1 million challenge right now, isn't it?
Many of the families we work with have substantial investments, and it's not uncommon for them to have not put a lot of thought into implementing their retirement income strategies. They're not facing any income challenges now, and they haven't explored how their future needs are going to be addressed or done much in the way of tax planning and estate planning. For these families, we can really help.
It's planning for situations that you may not see coming, and exactly what a written financial plan can help explore. It's clear that nearly every financial decision that you make or don't make can have some impact on other aspects of your financial present or future. So what would be some of the topics that you might encourage discussing?
Determining which assets generate income, which ones to take income from, and in which order to redeem assets from, that's huge. Add in tax planning and estate planning, and you've got to start to your own personal financial cookbook. The trick is ensuring, as different financial events transpire in your life, you make sure your financial plan always stays relevant to your changing circumstances. When the relationships are personal, the planning comes easy.
So, Jim, how do we get started?
If you haven't done it already, create a written financial plan and update it each year. In its simplest form, the plan will show where you are, where you're going, and what it will take to get you there.
You're listening to BoomerLife on CL 650. I'm Joanne Sutton in studio with Jim Doyle today, Senior Financial Consultant with Investors Group. And if you've been putting off getting your financial house in order, a second opinion could definitely help. And to learn more about how Jim Doyle can help you financially and make you a very financially comfortable Canadian, all you have to do is give him a phone call, 604-682-5431, or you can always email Jim, jim.doyle@investorsgroup.com. There's still a lot more to come on this show. Jim's got some great ideas on how to get the kids involved with your family's charitable planning. Remember, charity starts at home. That's next on BoomerLife on CL 650.
Celebrating the baby boomer lifestyle. This is Boomer Life on CL 650.